Nobody wants to pay tax on their crypto, but in the UK there are only a handful of situations where you can sell crypto at a profit and legally pay no tax at all. In this video, I'll break down the only ways it can be done so you know exactly how to do it. We'll start with the most straightforward way, but if it's overlooked, the allowance is lost for good, the annual exemption. For 25-26, that exemption is £3,000, representing a tax saving of up to £720. That exemption has reduced significantly over the last few years, falling from £12,300 to £3,000, which makes it more important than ever to make the most of it and use it every year. Depending on your situation, you may also be able to stagger your disposals across 2 tax years, using 2 annual exemptions. Even selling just before and just after the tax year end can work, effectively doubling your tax-free amount to £6,000 and saving up to £1,400. Remember, this one is use it or lose it. Once the tax year ends, the tax saving is gone. This next one catches a lot of people out because it feels like you've done everything right. Losses during the tax year are automatically offset against your gains, but there's a sting in the tail. The annual exemption is not preserved. Imagine a situation where you've realised losses of £6,000 so far in the tax year, and then realised gains of £6,000. You would avoid a tax liability because your net gains for the year would be nil. But there's the trap. Whilst you've avoided CGT, your losses have been used before your exemption. That's up to £720 of tax savings wasted. In that situation, you could actually realise a further gain of £3,000 in the same tax year and still not pay any tax because your annual exemption is still available. So the key takeaway here is to aim to preserve your annual exemption by realising gains at least £3,000 above your losses. Historic losses can be one of the most powerful ways to sell crypto without paying tax, but only if those losses were properly reported. And this is where most investors trip up. They never actually claim them. To claim losses properly, you either report them on your self-assessment tax return in the year of the loss, use the real-time CGT service, or you submit a written claim to HMRC within 4 years of the end of the tax year in which the loss was made. If you've done that, those losses can be carried forward indefinitely and applied against future gains. For example, if you have £10,000 of brought forward losses, you could crystallise gains of £10,000 without paying any tax. On top of that, you would still have your £3,000 annual exemption available. That means you could crystallise gains of £13,000 in a single tax year without paying any capital gains tax at all. The takeaway here is simple. Make sure your losses are actually claimed with HMRC so you can use both your losses and your annual exemption when you sell. This next one is long-standing capital gains tax treatment and applies to crypto too. It's about how the tax works between spouses. Transfers between spouses or civil partners who live together are made on a no gain, no loss basis, which means no tax is triggered at the point of the transfer. The receiving spouse effectively takes on the original base cost and the unrealised gain. This does not eliminate the tax altogether, but it can allow the receiving spouse to use their own annual exemption when they eventually sell. It's also worth thinking more holistically about who sells what. For example, if you both hold similar amounts of Bitcoin, but only want to sell half, it's worth considering who's best placed to sell based on available exemptions and any losses each of you has. Transfers must be genuine, but used properly, this is established and legitimate planning and allows couples to manage exposure and disposals far more effectively. The final option takes planning much further and sits in a completely different category altogether. It's not for everyone, but in some cases it can allow you to sell unlimited amounts of crypto without paying UK tax. In general terms, UK capital gains tax for crypto applies to UK residents. If you become non-resident by moving abroad, disposals you make whilst non-resident are usually outside the scope of UK tax. However, this is very much an area where professional advice is essential before making any disposals. There are also the UK's temporary non-residence rules to consider. These broadly mean that if you return to the UK within 5 years, disposals you made whilst non-resident can fall back within the scope of UK tax. In practice, this prevents a short-term move abroad simply to avoid UK tax. For smaller gains, moving abroad purely for tax reasons is often impractical and disproportionate, but this is definitely an option to consider for larger gains or where you were already planning to relocate. So those are the only situations where you can sell crypto and not pay tax in the UK. Using your annual exemption, offsetting gains within year losses, using historic losses, planning disposals between spouses, and in some cases, becoming non-resident. Thanks for watching, and if you found this useful, check out my other videos and feel free to leave any questions in the comments.